There's a moment in every investor's life that almost nobody talks about. It's the day your portfolio starts earning more money than you put into it. Think about that. For years, maybe decades, you're the engine. Every dollar in your account got there because you worked for it, saved it, and sent it in. Then one day, quietly, the math flips. Your money grows more in a year than you contributed. Your savings rate stops being the thing that drives your wealth, and compounding takes the wheel. That moment has a name. It's called the crossover point. And here's what almost nobody realizes. There isn't one crossover point. There are three. They sit at very different portfolio sizes, they mean completely different things, and most people mistake the first one for the finish line when it isn't even close. By the end of this video, you'll know exactly where each of the three sits, what actually changes at each one, and which one truly means you can stop working without flinching every time the market dips. This changes how you measure your progress, whether you're at $50,000 or $500,000. Let's get into it. Crossover number one, your growth beats your contributions. The first crossover is the moment your portfolio's annual growth becomes bigger than the amount you contribute each year. The math is simple. Say you invest $20,000 a year and the market returns around 7%. When your portfolio is small, your contributions dominate. You put in 20,000 and the market adds a few hundred. But as the balance grows, that 7% starts producing real money. Somewhere around $300,000, growth and contributions are roughly even, and past that, growth pulls ahead for good. Here's a rule of thumb you can do on a napkin. Roughly 20 times your annual contribution is where you're comfortably past this line. Invest $20,000 a year. Your first crossover is around $400,000. $30,000 a year? Around $600,000. $40,000? Around $800,000. Picture the year you actually land there. Your portfolio sits at $400,000. You contribute another $20,000. The market does its typical thing and hands you $28,000 in growth. For the first time in your life, your money out-earned your own labor. That is genuinely worth celebrating. So what changes? You can stop sprinting. The aggressive savings rate you've been white-knuckling doesn't need to keep climbing forever. You can breathe. But here's what does not change. You don't stop contributing, and there are three reasons why stopping here would be a serious mistake. First, the employer match. If your company matches even 50 cents on the dollar, that's an instant 50% return, guaranteed. You don't walk away from free money just because compounding finally kicked in. Second, the market moves. A 20% drop can knock you right back below the crossover in a single year. This isn't a switch you flip once. It's a line that moves. And third, lifestyle creep. The moment you stop saving, your spending quietly expands to absorb the difference. Now, the portfolio you crossed over with isn't enough for the life you've grown into. So the takeaway on crossover one, it means you can breathe. It does not mean you can stop. The engine just switched from your savings rate to compounding, and your job now is to stay in the game long enough for compounding to do its work. Crossover. Number two, your money out-earns you. The second crossover almost never gets named, and it's the one that actually starts to answer, can I retire? This is the moment your portfolio's annual growth exceeds what you earn from working. Your money makes more money than you do. The math is clean. At $1 million invested, a 7% return produces about $70,000 a year in growth. So if you earn $70,000 at your job, $1 million is your crossover. If you earn $150,000, the line sits closer to $2.1 million. Higher income means you need a bigger portfolio to cross it. This is the milestone where, in pure math terms, work becomes optional. Your portfolio is out-earning the trade of your time for money. But there's a trap here, and it's a big one. People hit this number in a strong market year, feel invincible, and assume the portfolio will always deliver. It won't. Look at the decade from 2000 to 2009. Over those 10 years, the S&P 500 delivered an annualized total return of roughly negative 1%. Negative. 10 full years. It was only the second negative decade in the index's history. The other was the Great Depression. A dollar invested at the start of 2000 was worth about 91 cents by the end of 2009. Think about what that means. Someone who hit $1 million in 1999, feeling great about crossing over, then watched the market fall nearly 50% at its worst, recover, and crater again in 2008. A decade of statements that went sideways and sometimes backwards. If their retirement plan depended on growth carrying them, it simply didn't. Now, and this is important because the honest version of this story matters, That lost decade hit US large cap stocks specifically. Investors who were genuinely diversified fared far better. International stocks, small cap value, real estate investment trusts, and even an equal weighted version of the same S&P 500 all produced solidly positive returns over that same stretch. So the lesson isn't stocks are a trap. The lesson is that concentration is riskier than people think, and that a long stretch of flat returns is a real possibility you have to plan for. So once you approach crossover 2, the question changes. It stops being, did I save enough? And starts being, is my plan sturdy enough to survive a bad decade? That's a completely different question, and it's what crossover 3 is built to answer. Crossover number 3, your income covers your life. The third crossover doesn't appear in most retirement calculators, and here's the fascinating part. It's actually the original definition of the term. The phrase crossover point comes from a book called Your Money or Your Life, written by Vicky Robin and Joe Dominguez back in 1992. And their definition was different from how the phrase gets used today. They weren't measuring portfolio size at all. They defined the crossover as the moment when the monthly income your investments produce exceeds your monthly expenses, not a multiple of your spending, actual income, arriving, covering your actual bills. The idea was that your assets pay your bills directly. You live on the income they generate and you never have to touch the principal. You're not selling anything, you're just collecting. And notice what this does to the math. If you spend $40,000 a year, you don't need a portfolio that can be drawn down. You need $40,000 a year of income. At a 5% yield, that's $800,000 of income producing assets, not $2 million. Here's where the history gets genuinely interesting. 2 years after that book came out, a financial planner named William Bengen published the research that gave us the 4% rule. The idea that you can withdraw 4% of your portfolio in year 1, adjust for inflation each year after, and probably not run out of money over a 30-year retirement, that's a fundamentally different framework. The 4% rule assumes you'll be selling shares each year to fund your life. The original crossover assumed you'd live on income and never sell at all. Bengen's research became the industry's default math, and over time, the phrase crossover point got quietly redefined around it into 25 times your annual spending, which is where most people land today. Same phrase, completely different concept. Now, I want to be careful and fair here because you'll see people online turn this into a conspiracy. It isn't one. The 4% rule is legitimate, well-researched, and it works for a lot of people. Most financial professionals are good at their jobs and genuinely serve their clients well. But it's also true that most advisors are compensated as a percentage of the assets they manage, typically around 1%. And that does create a structural incentive. If a client moves $200,000 out of a managed portfolio and into, say, a rental property or a CD ladder, the advisor's compensation on that money goes away. Multiply that across a whole practice, and you can see why the accumulate and withdraw framework tends to be the one that gets presented, and income-first approaches outside of managed portfolios tend not to appear on the menu. I'm not telling you the industry is out to get you. I'm telling you that incentives shape which options you get shown, and knowing both frameworks gives you back your choices. What counts as income and the honest catch? Under the original definition, anything that pays you reliably counts. Dividends from stocks, interest from bonds, rental income from property, interest from CDs. These pay you regardless of what the market price did that year and without selling the underlying asset. That's the entire point. Stock prices can drop 30% while the dividends largely keep arriving. Bonds keep paying their coupons. Rent keeps showing up. This is the crossover that doesn't break in a flat market. It's the only one of the three that survives a decade, like 2000 to 2009, intact. But I have to give you the honest catch because this channel doesn't sell you a story. Chasing income has real trade-offs. High-yield investments often carry higher risk. A very high yield is frequently the market telling you something is wrong. Dividend-focused portfolios can underperform broad growth over long periods. Bonds carry interest rate risk. Rental property is a job, not passive income. And some of the exotic income products people get pitched are genuinely risky and poorly understood. So the income-first framework isn't a magic cheat code, it's a different set of trade-offs. The honest position is this: growth-focused investing builds the biggest pile, income-focused investing builds the steadiest paychecks, and most people are best served by understanding both and blending them as they get closer to needing the money. 4 moves to make. So what do you actually do with all this? First, don't stop contributing no matter which crossover you hit. At minimum, always capture the full employer match. It's a guaranteed return you never walk away from. Second, and this is specific, so take it as something to look into, not as advice. If you're getting older with a large balance sitting entirely in pre-tax accounts, be aware you may be building a tax problem for your future self. Required withdrawals begin at 73 and every dollar is taxed as ordinary income. One oversized required withdrawal can push you into a higher bracket, drag more of your Social Security into taxation, and raise your Medicare premiums. Past a certain point, the smarter move is often to diversify across Roth and taxable accounts rather than piling everything into pre-tax. I did a whole video on this. It's worth a watch if that's you. Third, change what you measure. Most people track net worth, which is a fuzzy, bouncing number that includes things you'd never actually spend, like your house. Start tracking something better. How much income did my assets actually pay me last month? Dividends, interest, rent, money that arrived. That's the number you'll eventually live on. If you can answer that question, crossover 3 is in view. And fourth, stress test before you call yourself done. Take your portfolio, mentally knock 30% off it, and run the math again. If your plan only works when the market is at an all-time high, you're not crossed over. You're just at a peak balance. Those are very different things. The bottom line, here's what I want you to take from this. Crossing over is only half the work. The first crossover means you can stop sprinting. The second means work is becoming optional on paper. But the third, the original one, is the one that determines whether your freedom actually survives a bad decade. A high net worth without an income structure underneath it is just a big number waiting for a bad market. The structure is what turns a number into actual security. And if you're early in this journey, sitting at 10,000 or 50,000 and feeling like this is all very far away, it isn't. Understanding this now changes what you build. The person who spends their working years quietly assembling a mix of account types and asset types gives their future self dramatically more options. Every crossover you'll ever hit is being determined by what you do right now. The good news? You don't have to save forever at maximum intensity. There genuinely is a point where the machine takes over. You just have to build it right and then stay in the game long enough to let it run. If this reframed how you think about your own progress, do me a favor and subscribe. Net Worth Nation is for people who want the real mechanics of how money works. Not hype, not fear, just the numbers. Drop a comment below. Which crossover are you closest to right now? And has anyone ever explained the original definition to you before? I read every single comment, and your questions become future videos. If you know someone grinding away at their savings rate with no idea that a finish line even exists, share this with them. It might change how they see the next 10 years. I'll see you in the next one. Let's build.